We've hit 5,000 subscribers, which is such an amazing milestone, and I can't believe we've done it. So a big thanks to each and every one of you who subscribed and joined this journey. To celebrate, I thought what better way than to invest £5,000 into 5 companies that I think are stocks to buy now for 2022. This will hopefully also give you guys some ideas on buys at the moment because the market is tough. I have to warn you that this isn't going to be generic obvious picks. It's going to be solid companies based on sound fundamentals with potential for growth. With every stock I purchase, I'm looking at a 3 to 5 year timescale, unless something changes. And if it does, I'll let you know. I'll highlight my reasons to buy and the biggest threats facing the company, and you guys can make up your own mind. Now you're going to see that I'm actually buying these to show you guys I'm actually putting my money where my mouth is. So strap in, hit that like button, and let's do this. The first stock on my list is Coca-Cola HBC, not to be confused with Coca-Cola. The ticker symbol for this one is CCH. CCH has a dividend yield of 2.1% and a PE ratio of 25. Coca-Cola HC is one of the largest bottling partners of the Coca-Cola Company, with an exclusive license to produce and sell its drinks brands in 28 countries. Now let's talk about the reasons to buy. It has an unrivaled portfolio of consumer brands in the attractive and offensive beverages sector. There's multiple drivers for growth, including substantial exposure to high growth emerging markets. The company has a robust balance sheet and strong prospects of maintaining a track record of high cash generation and raising dividends. On Genuine Impact, it passed all of the criteria, being in the top category for ESG, share price stability, and its size. Its performance over the past year has been 10%, and its dividend strength is sound with 7.3% dividend growth. The share price is very stable and it has high liquidity. It operates in a diverse range of countries with a 45% segment in emerging markets. Now, the biggest threat, of course, is the breakdown of the relationship with Coca-Cola. But I don't think that'll happen. Coca-Cola and CCH have had a long-standing partnership that goes way back to 1969. Coca-Cola is also one of the main shareholders. It has a 23% stake in this company. Coca-Cola is known to be one of Warren Buffett's favourite companies, and Warren values rational management. I really can't see them not renewing this relationship in 2023 when the time comes. After a strong recovery from last year, 2021 earnings should be near or a little ahead of 2019, which was pre-pandemic. The stock's rated at 20 times those earnings. At the moment, the stock looks like good value, and I think it's capable of consistent double-digit returns and dividend growth from 2022 onwards. Of course, that one may not be the best option if you're looking for kind of green companies, but if you're looking for growth and a solid dividend, it's not a bad play. The second stock I'm buying is Macfarlane Group with the ticker symbol MACF. It has a dividend yield of 2% and a PE ratio of 20.93. Macfarlane's business division is packaging distribution, which at a top level is just what the name suggests. The division helps tens of thousands of customers source the right packaging for their products. Now my reasons to buy are as follows. It has a track record of growth via organic expansion and bolt-on mergers and acquisitions that could still have some way to run. There's opportunities for further growth in margins and in cash flow. It has a respectable yield of just shy of 2%, which combines current income and future growth potential. The biggest issues at the moment that face the company are supply chain issues. Thanks to the pandemic and the rising costs of inflation could also play a factor. The company will likely have to increase costs to stay profitable in an already low margin business. But the whole world is focused on fixing these supply chain issues at the moment, so I can see the situation only improving. They've performed incredibly well over the last year, over a 50% gain in a year. They are a growing and profitable business in an expanding market with opportunities to increase both cash flow and margin. Plus, their 2% dividend yield is a nice bonus on top of their current growth. The first two companies are in the packaging sector, and I think they're equally both good options with good growth and a strong dividend. Now the third stock on my list is a bit different and probably one you've never heard of. The third stock is Airtel Africa with the ticker symbol AAF. This one has a dividend yield of 2.96 and a PE ratio of 18. Airtel Africa is the continent's second largest telecoms company, offering data, voice and mobile money services, and it operates across 15 countries. Now my reasons to buy this one, it has exposure to countries with fast growing populations and rapidly rising demands for the services that it provides. It has an attractive 3.5% trailing yield and management has laid out plans to further increase dividends. It has an attractive valuation given the combination of near-term income returns and and potential for long-term growth. Airtel are ranked 982 in terms of value and 758 in momentum. They pass on all of the criteria except for expected return. Their performance has smashed the US stock market in the past 3 months and the last year. They've had a 35% gain compared to 4% in the market. They're valued at very cheap with a 7.5% forward PE ratio. Now, the biggest threat to this company is the government. There are challenges for Airtel, in particular their government legislation being quite unreliable. Another is the upcoming deadline to have all SIM cards in Nigeria registered. There's also issues extracting cash from Nigeria into USD and other currencies. But despite the speed bumps, Airtel Africa has a strong management team and it's navigated all of the obstacles well so far. With over 50% returns this year alone, I can see Airtel Africa having steady growth in years to come. Before we move on to number 4, I have to say a huge thank you to today's sponsor, which is AAX. Launched in 2019, AAX has more than 2 million members in over 100 countries and was a first exchange powered by LSEG technology. AAX is a direct exchange to allow you to directly deposit wrapped Ethereum. Now, wrapped Ethereum is great for crypto miners, but also good for everyday crypto users because the fees are much lower, up to 100 times cheaper, avoiding those high Ethereum gas fees. It also makes it super easy to swap Ethereum into other currencies, and it allows you to withdraw up to 2 Bitcoin without KYC verification. But the most impressive thing about AAX is its crypto earnings feature, which offers up to a 60% return on cryptocurrencies. You can choose to fix your investments over a set period of time for a higher return, such as a fixed 60% APY over 7 days on USDT, Bitcoin, Ethereum, and USDC. They also offer the option to select their flexible earning options, which you can withdraw at any time, like the popular 10% APY on Solana. They also offer DeFi staking, which allows you to receive up to 80% on some hot altcoins like SAMO and AXS. The platform's designed to be newbie friendly and is simple to use, and it's available on desktop and mobile for iOS and Android. Through December, they're offering a 50% sale on different tokens each week. For example, this week you'd be able to buy AAB tokens at 50% off as long as you hold 3,000 in savings. It's currently worth $103, so you'd be able to get $51 back. And you can also get a 10 and 20% discount if you don't want to save as much. If you're looking for an easy to use platform to get high returns on your crypto, then AAX is the place for you. The 4th stock I'm buying is Synopsys. Synopsys makes electronic design automation software for the semiconductor industry, and you could potentially call this a metaverse stock with a growing demand for their product. The earnings are forecast to grow 15% per year, while they've grown a whopping 28% per year over the past 5 years. My reasons to buy Synopsys are as follows. The rising demand for semiconductors has propelled this business to accelerating growth. It's a leader in must-have tools, mostly shielded from the industry it serves. It has diversified into licensed design IP and software security. Synopsys are the company on the list with the highest momentum at 98. No surprise there with the latest levels of growth. They pass on all criteria except for return and value, as they have shot up a lot lately. As you can see, their performance literally speaks for itself. They've been hitting their revenue and EPS targets for the past 2 years, just missing out slightly on their recent revenue targets. Synopsys stock has had a great run, up 75% over the past 12 months. In fact, the whole industry is at all-time highs. Now, the main issue is really the rising US to China trade tensions, which could threaten their sales. But if that does happen, Synopsys will likely hold up much better than its competitors. According to data from the World Semiconductor Trade Statistics, there have been only 2 periods on records when semiconductor unit sales actually declined. 2000 to 2001, the dot-com bust, and 2008 to 2010, the Great Recession. Synopsys grew through the recession and it actually bounced back even stronger than ever from a decline in 2001. So this company literally seems unstoppable, so it's definitely one I want to be a part of. Now, last but not least is one you're probably a lot more familiar with, which I'm buying, which is Airbnb. Now, Airbnb is a category leader that's poised itself to shape and benefit from the growth of the travel and hospitality industries. Its whole house offering compares well to a cramped hotel room for those interested in taking working holidays. Airbnb is already seeing a big benefit from this trend. Despite some lingering pandemic-related challenges, the business saw its best ever quarterly performance in Q3. Revenue is up 67%, while net income skyrocketed 283% year on year. The CEO, Brian Chesky, and other co-founders continue to guide the business, and own a large portion of the equity. The company's executives and directors' combined stake is over 35%, and it's a very founder-driven company. Between its accommodation and experience booking services, there's a total market opportunity worth roughly 3.4 trillion, and it's likely that this market will continue to expand. The first thing you'll notice about Airbnb is its value. 7,000th position is not the best, and that's because it's an expensive tech company like most tech companies. The momentum's very strong and it still has a huge growth potential. It's had huge historical returns, but the stock price is classed as very volatile. Now, the risks that face Airbnb are as follows. Regulatory risk may slow down their progress. A lot of their growth is currently factored in, and early investors now actually have a chance to sell. Airbnb is a service I use a lot, and I can see it going a long way in the future. At the current price, I think it's got great growth potential over the next 3 to 5 years. So that's another company I'll definitely be buying. So there you have my 5 buys. I've been on somewhat of a shopping spree this week in both my portfolio and my high growth portfolio. I've created a spreadsheet with all of these on, which I'll update when I buy and sell, and include my targets for each, the dividend dates, etc., which I'll link down below. And if you didn't catch my last portfolio update, I'll leave it right here. Make sure you have notifications turned on so you don't miss my next update. And once again, guys, thank you so much for subscribing and joining me on this crazy journey. Let's get more people investing, making money, and retiring early.